Have you ever wished you had a shortcut to understanding complex financial reports? Especially, from companies making big moves in the market.
It can feel like wading through jargon sometimes.
Exactly. So today on the deep dive, we're going to try and cut through that noise. We're looking at Can Fin Homes Ltd's Q1 FY26 performance.
Mhm.
We've got their press release, investor presentation, even the auditor reports right here. The goal is to pull out the clear, actionable stuff for you.
Yeah, our mission here is really to unpack what these numbers truly mean. We'll highlight the key trends, give some context,
Yeah.
basically show how a major housing finance player is doing in today's economy,
Right.
and hopefully give you that thorough understanding without, the usual information overload.
And it's not just the raw figures, is it? We'll look at financials, sure, but also their strategies, operations.
Yeah, and even their wider commitments, like social and environmental stuff.
Definitely. I'm actually quite curious to see if we uncover any aha moments or maybe some surprising facts along the way, things that might stick with you.
Let's see what we find.
Okay, so let's unpack this. Starting with the core results for the quarter ending June 30th, 2025. How do they stack up against last year?
Well, the picture looks pretty solid overall. Growth is definitely there.
Okay, give us the headlines.
All right. So net profit after tax, PAT, that grew by 12%, came in at Rs 223 crore, up from 200 crore last year.
12%, okay, and before tax.
Profit before tax, PBT, that rose by 9%. So Rs 278 crore compared to Rs 255 crore.
Got it. What about their main business, the loans?
Loan assets are up 9% too. They've reached Rs 38,773 crore now.
Big number.
It is. And loan disbursements, how much they actually lent out in the quarter, also showed 9% year-on-year growth. That hit Rs 2,015 crore.
So consistent 9% growth on assets and disbursements. What's your initial take on just these top-line numbers?
Well, what's fascinating here is that consistency, right? It suggests a steady positive trajectory, not just like a one-off good quarter. And it goes beyond just volume. We see improvements in their efficiency metrics too, their net interest margin, and IM, that's key for profitability and lending.
Right.
It increased slightly to 3.64%. The spread also improved a bit to 2.62%.
Okay, so making a bit more on their lending activities.
Exactly.
Yeah.
And return on assets, ROA, also saw a small bump up to 2.19%.
Good, good. Anything else?
Well, there's return on equity, ROE. That actually dipped slightly to 16.93% from 17.57%.
Oh, interesting. Is that a concern?
Maybe not a major one in context. I mean, almost 17% ROE is still quite robust for an HFC, especially one that's expanding its physical footprint, opening new offices.
Ah, okay. So it could be tied to investment in growth.
Possibly.
Right.
It suggests maybe a strategic trade-off, perhaps for future growth, or just shoring up capital rather than, a sign of weakening profitability. That's a key distinction.
Right.
But on a very positive note, their debt-to-equity ratio improved. It actually decreased to 6.71 from 7.14.
Which means less debt relative to equity.
Precisely. Stronger financial leverage, a healthier balance sheet. That's definitely a plus.
Okay, that's a great overview to start.
Yeah.
But, the real story is often in the details, isn't it?
Always.
What's actually driving these numbers? Any complexities we should know about? I saw something about an accounting change.
Ah, yes, that's right. They changed how they record loan initiation charges.
Mm-hmm.
Now they do it at gross value, not net.
And that impacted the profit.
It did, yeah. Boosted the Q1 profit by about Rs 3.53 crore. Not huge, but, worth noting.
Okay. And on the other side, costs. I saw the cost-to-income ratio went up.
It did, yeah. Up to 18.33% from about 14.87%.
Why the jump?
They pinned it on two main things. One, salary revision sounds like they're aligning compensation with the market, which makes sense.
Standard practice, yeah.
And two, the costs of opening those 32 new offices. You've got 25 branches, 6 zonal offices, and an extension to their head office. That all cost money up front.
Right. Investments that probably drag on the ratio initially, but hopefully pay off later.
That would be the plan, yes.
Okay, let's shift gears slightly. Asset quality. Gross non-performing assets, GNPA. They ticked up a bit.
Just slightly, yeah. GNPA went to 0.98% from 0.91%, and net NPA, that's after provisions, went to 0.54% from 0.49%.
So looking at that small increase, how well are they actually managing risk? Should we be worried? And what about their liquidity?
That's the critical question, isn't it? And honestly, looking at the reports, they seem to be managing it quite robustly.
How so?
Well, despite that little uptick in NPAs, Look at their provisions. They're carrying a total provision of Rs 492 crore.
Okay.
That breaks down into 377 crore for expected credit losses, 59 crore as a management overlay, sort of an extra buffer, and 49 crore for restructured accounts.
And the coverage ratio?
It's at 45.15%. Pretty healthy. It shows they're being proactive about potential defaults.
Okay.
And here's something interesting.
Mhm.
The total delinquency.
Yeah.
The amount of loans overdue, it actually decreased from the last quarter.
Oh, really?
Yeah, it dropped from over 4,200 crore in Q4 FY25 down to just under 4,000 crore this quarter.
So better collections.
Looks like it. Improved collections, maybe better management of stressed assets. And on liquidity, they look very strong.
How strong?
Their liquidity coverage ratio, LCR, is 282%.
Wow, okay. And the requirement
That
is?
would be 85%.
Yeah.
So they have a massive buffer of high-quality liquid assets. Plus, they have over 3,000 crore in undrawn bank lines documented. Plenty of liquidity.
That sounds very secure. What about where they get their funding from? Is it diversified?
Very much so. That's a key strength, I think. About 56% comes from banks.
Okay.
Then 20% from NCDs. Those are non-convertible debentures, basically long-term bonds. 16% from the National Housing Bank, which is important support.
Right. NHG.
7% from commercial paper, that's short-term debt. And just 1% from deposits currently. So a good spread reduces reliance on any one source.
And the cost of that funding?
That's another positive. Their average cost of borrowing actually went down slightly from
Yeah.
7.58% to 7.47%.
Which helps their margins.
Directly, yeah.
You mentioned deposits were only 1%. Are they trying to grow that?
Well, they are actually. They're actively working on strengthening their deposit base. They're offering a pretty attractive 8% interest rate on 36-month cumulative deposits.
8% is good.
It is. And senior citizens get an extra 0.25%. Plus, their deposit program has a AAA rating from ICRA. That signals high safety, which should help attract depositors.
Makes sense. And the NCDs? Any movement there?
Yep. They issued Rs 980 crore in new NCDs during the quarter, but they also redeemed Rs 1360 crore worth of older ones.
So managing their debt profile actively.
Seems so. And critically, they've maintained 100% asset cover on their secured NCDs. The auditors confirmed everything's in line, no deviation in how funds were used, full compliance with all the rules, the covenants.
That's crucial for investor trust.
Absolutely. Regulatory adherence and transparency are key there.
Okay, let's zoom in on the loan portfolio itself. What kind of loans are they focusing on?
Well, no surprise here. Their core remains housing. Housing loans make up 75% of the total book.
3/4, yeah.
The rest, 25%, is non-housing, which includes some commercial real estate lending.
And who are they lending to mainly?
The bulk, 70% of the outstanding loans, belongs to the salaried and professional segment. That's generally seen as a more stable customer base.
Right. What about the loan sizes?
The average ticket size for new housing loans is around Rs 24 lakh. For non-housing, it's about Rs 14 lakh.
Okay.
But here's an interesting shift looking at disbursements by ticket size. Loans over Rs 30 lakh made up 41% of new disbursements in Q1 FY26.
And that's up from?
Up from 37% in the same quarter last year.
What does that suggest to you? Moving slightly up market.
It could well be. It suggests a strategic move towards maybe higher value properties or borrowers, perhaps targeting more affluent customers or focusing on larger cities where property values are higher.
Interesting. How do they actually get this business? Where do the leads come from?
The vast majority, 79% in Q1, came through the DSA channel direct selling agents.
Okay, that's common in the industry.
It is. But what's notable is that there isn't a heavy reliance on just a few big DSAs. The top 20 DSAs only accounted for 8% of the business.
No, it's well-diversified sourcing. Less risky.
Exactly. Reduces dependency. And one more thing. Good news for their customers.
Oh, yeah.
They recently passed on some interest rate benefits, a 10 basis point reduction effective May 2025, and another 15 basis points from July 2025.
So lower EMIs for borrowers on a quarterly reset basis.
That's right. It helps the borrowers, obviously, but it also makes Can Fin more competitive in the marketplace.
Definitely a good move. Okay, so we've covered the numbers, the operations, the sourcing, but let's zoom out again.
The bigger picture.
Yeah. To really get Can Fin Homes, we need to understand their foundations, their long-term vision. What does it all add up to?
Well, context is key here.
Right. I mean, this isn't a new company. They've got a 38-year history. They're a deposit-taking HFC started by Canara Bank.
Which still holds about a 30% stake, providing that strong backing.
And they've paid dividends every single year since 1991, apparently. That's quite a track record.
It really is. Speaks volumes about stability and shareholder return.
Their motto is friendship, finance, and good service, focused mainly on individual housing loans. And they're not small, 234 branches across 21 states based in Bengaluru.
That pan-India presence is significant.
And they've hit some big milestones like crossing R's 10,000 crore loan book back in 2013 and now over R's 38,000 crore in AUM. So how does this deep history shape their strategy now for 2025 and beyond?
Well, if we connect that legacy to the present, you can see their strengths are really embedded. That consistent support from Canara Bank is huge.
Right.
Plus, nearly 4 decades of specialized expertise in just housing finance. That gives them a real edge. Their processes are known for being pretty quick, customer-friendly.
The single window approach you mentioned.
Exactly. Branch-led, risk-based evaluation. And they layer on robust due diligence. They use the CKYC UIDI link, that's the central KYC system tied to India's national ID. They use Perfios for automated bank statement analysis, plus physical field checks. It's quite thorough.
All contributes to managing risk.
Absolutely. And it underpins that consistent liquidity and their ability to keep paying those dividends year after year. It's all connected.
And looking forward, what about tech and maybe sustainability?
Yeah, they're definitely focused on the future, too. There's a big IT transformation project underway, expected to go live in Q3 FY26.
What's the aim there?
Digital financial services, more automation, building secure digital platforms, basically, modernizing their capabilities and protecting customer data better.
Essential these days.
Totally. And what's also impressive, I think, are their ESG initiatives, environment, social, governance. They seem quite comprehensive.
Like what? Give us some examples.
Okay, on the environment front.
Yeah.
Yes, they're doing the internal stuff like solar panels on offices, LED lighting, reducing plastic.
Standard greening efforts.
Right. But they also have a rooftop solar loan scheme for customers. And they're doing tangible community projects, like restoring an area in Kersi village, planted 2,500 trees, built a rainwater harvesting pond that holds over 1 million liters.
Wow.
And they restored a 3-acre pond, Meenakshi Kulam, increasing its capacity to 5 crore liters, plus solar streetlights, e-waste recycling. It's quite extensive.
That sounds genuinely impactful, not just greenwashing.
Seems that way. Socially, they emphasize data privacy, cybersecurity training for staff, comprehensive employee benefits insurance, paternity leave. They've also increased female recruitment by nearly 9%.
Good to hear.
And tons of training, 30,000 hours, covering almost all staff on things like POSH, that's prevention of sexual harassment, ESG itself, risk management, and governance-wise, they boost transparency by putting investor call transcripts right on their website.
So, trying to be responsible corporate citizens across the board.
It certainly looks like a core part of their strategy. These things aren't just nice-to-haves anymore. They build long-term resilience and, frankly, brand value.
Definitely. Okay, just to wrap up the specific news from the quarter. The board approved these Q1 results we've been discussing.
Standard procedure.
And they also approved appointing Sri Hardeep Singh Ahluwalia as an additional director. He's representing Canara Bank. That's still subject to RBI and shareholder approval, though.
Right. Formalities to complete there.
And a reminder for shareholders listening, the final dividend for last financial year, FY25, was Rs6 per share. That was declared back in April, but it also needs shareholder approval at the upcoming AGM.
Good point. Always subject to that final app.
So pulling it all together then, our deep dive suggests Can Fin Homes had a strong Q1 FY26. We're seeing solid financial growth.
Driven by pretty robust operations and strategic moves like that focus on slightly higher ticket sizes.
Exactly. And underpinned by what seems like a genuine commitment to sustainability and good governance. They're balancing growth with stability and, well, ethical practices.
Yeah, it appears so. Which leads to an interesting thought, perhaps.
Yeah.
Well, considering Can Fin Homes' consistent growth, their deep focus specifically on housing and this clear commitment to ESG, what role do you think institutions like this, focused, long-standing, rooted in a specific sector play, not just in the economy, but maybe in shaping society, social well-being in a developing country like India?
That is a powerful question to think about. What is the broader impact beyond just the balance sheet? Definitely food for thought.
Something to mull over.
Indeed. Well, thank you for joining us on this deep dive into Can Fin Homes. We hope you found it insightful. As always, we encourage you to keep exploring, keep questioning.
And keep staying informed.
Exactly. Thanks for listening.